Hello traders, welcome to CryptoPi. Today I want to talk about three pillars of successful trading. The first one would be stop loss, second is position size, and the third is risk. We discussed about all these 3 points in the previous videos, and today I want to show its significance in trading in different market other than USDT as well. More specifically, trading an altcoin in the BTC pair. We will look at the Ethereum chart in the BTC market. In the last video, we saw Ethereum in the USDT pair. We computed the position size based on stop loss, and we computed how much our reward will be. Now, what we see here is Ethereum on the daily time frame, where it has put a low for this cycle on April 24th, which was not the all-time low, but if we look at the dominance of Ethereum over here, then we can see that on April 24th, the Ethereum dominance went far below its previous all-time lows. There is nothing before here, so apparently it did cross its all-time low. There's a quite good chance that it might get a slight pullback, which would indicate that Ethereum weakens in the Bitcoin pair. But as soon as the quantitative easing begins, there is a very good chance that Ethereum picks up its trend to go upwards, perhaps until 16%, when the BTC dominance is going down and Ethereum dominance is going up. Perhaps Ethereum dominance can reach until 16%. Now, coming to trading Ethereum in BTC, we will follow the same steps which we did during the Ethereum in USDT pair. So the first step is to identify the trend. And we see here the trend has started moving upwards, but it can also be some kind of pullback, which is like this one, or over here, or over here. We can also activate the stop loss band. Let me hide the strategies and just activate the stop loss band. Alright, it is already activated here. And we see that the stop loss band is still in the red zone, or showing us the downtrend. One can always take a trade here, but it is much more risky to take a trade here from an investing point of view rather than a trading point of view, because in trading you can manage your risk. If one can take a long here, there is a defined stop loss, a defined risk. To take some example on trading Ethereum in a Bitcoin pair, we can perhaps move to a lower time frame such as 4 hour and switch on our strategies and see if there are any strategies which are showing us an uptrend. So we do see here one of the uptrend signal, so that's a long signal. And now I'll take a long position, assuming that strategy 5 works, and my stop loss will be just below this green band line over here. Although it's not live and we already see that the price is going against our direction, the stop loss basically allows a room for price to fluctuate or fill up the price action gaps over here, and then decide whether it continues to go down or go up. Let's see what was our stop loss. It is at 7.94%. We go back to our calculation, where on paper trading calculation, where let's say the trading amount which is allocated is 0.5 BTC, the risk we decide we want to take it as 2%, and our stop loss is at 7.94%. So we will write here 7.94%, and immediately we see that the position size will be 0.126. The reward, we do not know yet, but let us be consistent with our previous videos and make it to 1.5, and that comes at about 11.94%, which will be 11.94%. So if the trade is taken at the 1 to 1.5 ratio, the profit will be 0.015 BTC. This should be BTC. As you can see that this equation of position size works in BTC as well as for USDT. And in the last video I mentioned, or the video before that we have to be careful about setting our stop loss below 1%, because in that example the risk was 1%, and when you set stop loss below the risk percentage, then you end up taking more leverage. So let's say if I put it 0.5%, that is my stop loss. So again, the risk is 1%, stop loss 0.5, that means our stop loss is less than the risk. Then our position size becomes higher than the trading amount, and at this stage trading like this cannot be done because we do not have the trading amount. But at this point one takes the leverage, and that's why a lot of people get liquidated, because they do not take into account where is the stop loss with respect to their risk. Most of the time they compute only the risk, and they do not compute risk in relation to stop loss. If we simplify this, going to the USDT position, let's say we have $1,000 in the trading amount. Oh, this is a typo here. Let's fix that. Trading amount, probably there is also typo here. Yes, exactly. Yeah. And if my stop loss is 2, and my risk taken is 2, what we see here is our position size is exactly as same as our trading amount. Now if I reduce my stop loss to 1%, this will increase by 2,000. At this point I would have to take a 2x leverage, or it depends upon how much fees are you paying, how much commission are you paying, and then this position size has to be taken based on what is the leverage offered by the exchange. And that is the reason why one has to be very careful while placing their stop loss. The stop loss should be always greater than the risk which is taken. So here I would say, let's say 3%, and then my position size reduces to 666. That would be all for today's video. If you like the content, do subscribe and give it a like, and it would be nice to hear your feedback. Thanks a lot, and see you in the next one. Bye bye.